Let's talk about inventory. And no, it's not just about boxes on a shelf. It is a critical asset, one that can literally make or break a company's bottom line. So, in this explainer, we're going to decode exactly how companies report and value this stuff, and more importantly, how you can analyze it to get some really powerful insights into a company's financial health.
Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. All right, we're going to break this down into 5 key parts. We'll start with the basics. What even counts as a company's inventory? You'd be surprised, it's not always as obvious as it seems. Then we'll jump into the really interesting part, how it's valued. After that, we'll see the huge impact that choice can have on the financial statements. Look at what happens when simple errors creep in. And finally, wrap it all up by showing you how to analyze inventory like an expert. Okay, so let's start at the beginning. What inventory does a company actually own? I know, it sounds super simple, but you're about to see that where the goods are physically sitting, well, that doesn't always tell you the whole story. So picture this. A truck is loaded up with a company's product. Is it still their inventory? This is a classic accounting puzzle, and the answer? Well, it all comes down to the shipping terms. Those terms define the exact moment that legal ownership, the title, transfers from the seller to the buyer. And the key to that puzzle is a term you'll see a lot, FOB, which stands for free on board. Here's an easy way to think about it. With FOB shipping point, the ownership changes hands the second that product gets on the truck. It's the buyer's problem now. But with FOB destination, the seller is on the hook. They own it all the way until it's actually delivered. You can see why getting this right is so important, especially when you've got a lot of stuff in transit at the end of the year. Now, that brings us to another really interesting category, consigned goods. You've seen these everywhere. These are products that a store sells but doesn't actually own. The real owner, we call them the consignor, still holds the legal title. And that means those goods, they have to be counted in the consignor's inventory, even if they're sitting on a shelf in a completely different store. And yeah, you really do see this all the time. Just think about the magazine rack at your grocery store, or maybe the used textbook section at a university bookstore. In those cases, the store is just acting as a sales agent. They're the consignee. But the publisher, or the student who owns that textbook, they're the true owner, the consignee, right up until the moment that item sells. Okay, so we figured out what to count. Now for the next big question. How much is all that stuff worth? You know, assigning a dollar value is pretty easy when prices are stable. But what about when they're bouncing around all the time? That's when things get tricky, and that's exactly where accounting methods become absolutely critical. And this really is the central challenge, isn't it? If a company buys the exact same item multiple times in a month, but at different prices, which cost do you use when you sell one? Do you use the first price, the last price, some kind of average? It might sound like a small detail, but the answer you choose has a major impact on the company's financial statements. Well, to solve this problem, accountants basically have 3 main tools in their toolkit. For really unique high-value items, think cars or fine art, they use something called specific identification. It's easy. You just track the exact cost of each individual item. But for pretty much everything else, where all the items are identical, companies have to choose between 2 big approaches: first in, first out, or FIFO, and the average cost method. So the FIFO formula, first in, first out, works on a really simple and logical idea. The first things you bought are the first things you're going to sell. This often matches how things work in the real world, right? Like milk at a grocery store. You always want to sell the oldest stuff first, so it doesn't go bad. To really see how this plays out, let's walk through this bicycle shop example. Take a look at the purchase prices. See how they're climbing throughout June, from $100 a unit all the way up to $130? This is a classic inflationary environment, and it's perfect for showing the big differences between the costing methods. Now, for that first sale of 300 bikes, the FIFO logic is super simple. We just assume the shop sold the oldest, and in this case, the cheapest bikes first, the ones they bought for $100 each. So the cost of goods sold for that particular sale, it's a straight shot, $30,000. Okay, so after all the sales for the month are tallied up, here's the bottom line using FIFO. The total cost of goods sold comes out to $113,000. And the stuff left in inventory? Well, that's the newest, most expensive bikes, and they're valued at $32,500. And that right there is a key feature of how FIFO works when prices are on the rise. All right, so now let's switch gears and look at the alternative, the average cost method. This one is different.
Instead of tracking all those individual purchase layers, this method just smooths everything out. Every time you make a new purchase, you calculate a brand new weighted average cost for all the identical items you have in stock. So what happens when we run the same bike shop numbers through the average cost method? We get a totally different outcome. Take a look. The cost of goods sold is now higher. It's up to $114,667. And because of that, the ending inventory value is lower, down at $30,833. And here is the crucial takeaway. When you put them side by side, you can see this isn't just some boring accounting detail. It's a strategic choice. In a market where prices are going up, FIFO gives you a lower cost of goods sold. And what does a lower cost mean? It means higher reported profit. It's that simple. That difference in profit is exactly what we're going to dive into next. Because this choice between FIFO and average cost, it creates this massive ripple effect that completely changes how a company's performance looks, both on its income statement and on its balance sheet. So, during a period of inflation, just like in our bike shop example, FIFO takes those older, cheaper costs and matches them against today's higher sales prices. What's the result? A lower cost of goods sold, a higher gross profit, and at the end of the day, the highest possible net income. The average cost method, on the other hand, it pulls in some of those newer, more expensive costs, which leads to a higher COGS and, you guessed it, lower net income. And this affects the balance sheet too. With FIFO, the ending inventory value is more relevant because it's made up of the most recent, most expensive purchases. That means the value you see on the balance sheet is a lot closer to what it would actually cost to replace that inventory today. The average cost method, it's going to have some of those older, cheaper costs mixed in, so the inventory value won't reflect current prices as accurately. Now, given how important these numbers are, it should come as no surprise that even a small error in counting or costing inventory can have a huge ripple effect. An inventory error never just stays in one place, it spreads. Seriously, think of it like a line of dominoes. One wrong number in your inventory count, and it just knocks over everything else. It throws off your cost of goods sold, which means your profit is wrong. Then that wrong profit number flows over to the balance sheet, messing up your assets and your equity. It's one single error that basically contaminates the entire set of financial statements. Okay, so now that we've got the mechanics down, let's get to the fun part, the analysis. We're going to look at one final important valuation rule, and then we'll dive into the key metrics that analysts use to figure out if a company is actually managing its inventory well. There's this really important rule in accounting called lower of cost and net realizable value, or LCNRV. Think of it as a rule of caution, of conservatism. It's pretty simple. If the market value of your inventory drops below what you paid for it, you have to write it down and book a loss. You're not allowed to pretend it's worth more than what you could actually sell it for today. All right, let's talk about a crucial metric, inventory turnover. This ratio tells you how many times a company sells and replaces its entire stock of goods over a certain period. A high turnover is kind of like a fast metabolism for a business. It's a great sign of efficiency and means that cash isn't just sitting there tied up in products on the shelves. And an even more intuitive way to think about this is a related metric called days in inventory. This one's super straightforward. It tells you, on average, how many days an item sits on the shelf before somebody buys it. For a grocery store selling fresh vegetables, you want that number to be tiny, right? But for something like a car dealership, it's naturally going to be a lot higher. And this all leaves us with one last critical question to think about. We know that a high turnover is generally a good thing, a sign of efficiency. But can it be too high? And the answer is yes, absolutely. An extremely high turnover might be a red flag that the company is constantly understocking, running out of products, and leaving customers empty-handed. It just goes to show you there's a really delicate balance at the heart of managing inventory effectively.